really appreciative having you. It's as I mentioned, this is something I look forward to, and hearing your wonderful voice and sometimes seeing your faces. It gives me comfort, especially the times that we've been so secluded that it's just nice to have that connection. Although we don't see each other in person, this is becoming a family to me now. So again, thank you so much for being here. Every week I think, oh, we had an exciting week, and the following week happens, and then we had another exciting week. So it has been hopefully profitable and rewarding to you. If anything else, I'm sure it has been entertaining and educational. So um, speaking of that, this is what I want to start with, quote that it's my own thing, and I've always been concerned with the little knowledge, and little knowledge combined with a lucky streak, it spells dynamite. And the reason I use this saying is, you know, dynamite, when Alfred Nobel, he hadn't actually noble intention. It could be constructive as well as destructive. Dynamite, as you know, you can build many things while you're destroying things, and then destructive, it can be obviously life-ending and ending construction that you've had. So uh, with the times that we've been, especially since March with this COVID-19 and all uh, the consequences of that, has created something that I hadn't seen probably since late 90s when we had the internet bubble. What has happened, we've had investors who've come in, they've probably watched with so much access to information. They have spent so much time, and again, with little need for investments, no commissions. It has created a wave that with the markets doing well, obviously, it has created maybe a false sense of security. A few weeks ago, I mentioned about 6 or 7 weeks ago, I thought, you know, with the TD Ameritrades of the world and Robinhood, now they call them the Robinhood effect, and the Charles Schwabs of the world, we've had over 3 million retail accounts open. And that was a little concerning to me. And I mentioned, not that the markets completely are managed by that. I had mentioned that overnight, we've had a lot of activities with a very low volume. And if you even this week, if you go back and look at the charts, we had many gaps, ups or downs, and they got actually filled. But there's a lot of activities are happening overnight. So, you know, after markets overseas. So this is something more concerning than having the retail investors. Uh, my biggest concern with retail investors is the psychology of things. It's not that they are moving the markets, and it's my concern is when the things are good, the things are okay. We are high on that. But when things get bad and we have big drops, psychologically the effects are devastating. And it takes me back to the late 90s and 2000, 2001. And basically, I remember that every party, I've mentioned it before, a lot of people were bragging how much money they're making and they're going to retire the following year and life is so good. Well, I see the same people now. They're still working. They haven't retired, many of them. Some of them did retire because of their age. But when I talk to some of them, they say, well, we're still using our capital losses from those days. So my purpose, again, with our gathering here is I'm hoping to give you the tools that is not just for short term, it is educational, it's a fundamental understanding of what's happening. So really you become independent in your decision making. It is a process. It is not going to happen overnight. It is not something that basically, like I use a sports analogy a lot. I mean, you're just not going to be the top goal scorer in soccer or be the greatest filter, shooter in basketball. It is something that it takes time. It sometimes is boring, but it is a process. And when it happens, it's very rewarding. And I use this picture, um, assuming that you're in a nice party in Scotland, for instance. It's beautiful and you're having fun, lots of drinks, and basically everybody's buzzed, but you have a big meeting and your ride is drunk. So if that's the case, it's a beautiful Scotland in a castle. It's raining outside. Well, I want to make sure you know actually how to drive and go home by yourself. If it's the case also, I want to make sure you know how to call an Uber or have a taxi. The thing is, you want to have the tools. And the thing is, right now, I think the central governments are providing all you can drink. We are all probably, there's all alcohol is a good times. But my concerns are the after effects when the headaches, and that's the easiest thing, but maybe there are accidents, people are going to drive drunk. And so those are my concerns. So this is the reason I look forward to our Saturdays. I look forward, hopefully, giving you some understandings of the markets and the tools to analyze them. And again, make the independent decision that if you make mistakes, you will learn from them. It's the tuition you have to pay to the market. And if you win, you know why, and you have to write it down. The luck plays a little role, but I mentioned last week, and I think we had a conversation, that I think the decade of 20s, as much as I think I'm very positive because of the evolvement of things, especially with the technological developments and younger demographics that are coming up, especially from developing countries, it is going to be challenging for the passive investors. So these are the good times to be prepared and learn as much as you can. This came in the beginning of the week. Again, we've talked about Robinhood traders, and again, now you see a lot of pundits on TV come and say, oh, there are the reasons we have this volatility. I think they play roles because, again, when you have 3 million new accounts, obviously there is some kind of a euphoria from that. But not everyone have a large account. You can start small accounts with Robinhood, but it's not just Robinhood. There's, as you mentioned, there's trades, the TD Ameritrade, there's TradeStation, there is Charles Schwab, Fidelity. So basically, the reason is not that these retailers, my reasoning is there is that the volatility of not understanding why things happen. And when things are cheap, there's a reason they're cheap. And that's when you want to make sure that when you buy something, you have a reason for it. If you sell something, there's a reason for it. I also don't put, okay, maybe it's my age, but not a lot on academic studies of the markets. I really enjoy it. I learned something, but they are not absolute. So I think they looked at the Robin track and did make the decision. But I think there are reasons. And one of the reasons is this is Hertz. And Hertz, the company announced they're going bankrupt. And they hit the low of like 37, 38 cents toward end of the third, fourth week of May. Then they closed at 55 cents. And they went and hit I think $5 and change. After they have, they had announced that they have bankruptcies. And this is from the Robin track, and it shows that these are the Robin account holdings. These are the options on these, and look how many accounts they hold the options, the call options, and that's what concerns me a little bit. And talking about the academic studies, as you know, most of you. I'm just a big fan of sports, mainly soccer. I've loved it since I was 5 years old. And since 2010, I think it's even 2006, there's a lot of companies would come, a lot of banks, they try to make a prediction about the World Cup. And this is from 2018, and this was an interesting headline. Elite banks predicted World Cup AI model, and they weren't even close. in 2014, for some of you remember, it was Brazil's World Cup. And Jim O'Neill at that time was the CEO of Goldman Sachs, and he's a big soccer fan. And he spent about $10 million on the prediction of a model for the World Cup winner. This is before the World Cup started. And his prediction was Spain versus Brazil. If you followed, some of you followed the World Cup then, Spain got eliminated, and they were the reigning World Cup champions, eliminated on the opening stage, in the group stage, and they actually got demolished. And Brazil had one of the worst showing. It was amazing how the way they lost to Germany, and then obviously in the third and fourth place they played against Netherlands. So this is just a little hesitation about following academics, because at the same time we had these World Cup psychic animals and had great results. I mean, we had the Paul the Octopus, Sergeant Oscar the macaws, and for Brazil the octopus was almost flawless in the predictions. He died shortly after his predictions in the South African World Cup, and then we had Achilles the cat for the 2018 Russia World Cup. So basically, I mean, they did much better than the prediction of $10 million, which actually right after the group stage, Goldman Sachs came and they did another study, and they thought Brazil will be going to go to finals. They predicted the 4 top finalists the right way: Germany, Argentina, Brazil, and Netherlands, but not in the right order. So this is what I just think it's important for you to have your own tools, make your own decisions. Don't follow all the news and the pundits. Be independent, but make sure you have all the knowledge that you can get, but practice, practice, practice. It's a process, and eventually it comes all together. So with that in mind, let's review the economy the way it was last week. And as always, I really, again, like this from the First Advisors, I look at under the hood. We want to see, okay, initial jobless claims are, again, coming down. That's good news, but still it's a large number. These people are out there without jobs, and they're on unemployment. Granted, some of them are making more money than they were making as employed, but it is concerning. We look at the retail sales, just started now. We can see what is happening. I will go a little more about the retail. And then the box office receipts are increasing tiny bit, but they're no way close to what they were. I don't know in near future anyone is going to any movie theaters. There's still those concerns. The rest, again, one of the ones is hotel occupancy. We look at the previous week, and then we look at what is happening basically now. Month over 9.2%, we are at 2.7%. And also this is the average daily rate, is important. So we are at $85. And the direction is up. I mean, people are going out, and they are traveling a little more. Again, I look at the TSA, the checkpoints, there is upbeat. The flights, again, a lot of people still not doing it as a leisure. They're basically doing it more of a necessity maybe, but the direction is the right way, but all we need is, if there's a second wave, things will really change. So I thought let's review the economic risks, and let's make our own judgment of the next year, 2 years, and that, especially after Chairman Powell came and spoke about his thoughts and what is the Fed is going to do. And he basically acknowledged all these risks, a lot of these risks. So I thought, let's review them one by one. Obviously, there's an uncertainty about pandemic. We really don't know. I mean, Friday was a really good example with what is happening. First, it started in Beijing, and then what is happening in from Florida to Texas, even Southern California. There's a concern. Apple comes and closes only 11 stores in Arizona, and there's a big concern the market drops. So we're still at the mercy of, again, exogenous as far as events. So the markets, the volatility is not going to go away. The question is how powerful these economic forces are in the direction of stock market when we talk about. But these risks are out there. The small businesses, it breaks my heart. And if you've been to some of the restaurants, I mean, a lot of these restaurants, they cannot even survive based on 8%, I mean, 80%, forget about 60%. I mean, this is not easy, and there's a lot of big bankruptcy risk, which we haven't taken into consideration. The service industry as a whole, you know, all these restaurants and leisure, you know, hotels, casinos, they all hire these people that they depend on their tips, they depend on their work, and they also are consumers. So based on that, you will have some domino effect. So because of the lower demand risk, you're going to have basically lower hiring. The global supply chain risk, basically because of the trade wars, but also with what is happening with the supply chains, with the imports, putting the restrictions. So that's another risk. And then obviously the biggest one, we spoke many weeks ago about the, as far as components of the GDP, especially in the United States, as you know, 70% is a consumer driven. And majority of that is also in the service area. And as you can see, we are really not going out. We are not spending as much money. The retail numbers came last week and everybody was so excited. But if you look at the underneath the hood, and I will review that with you, it's a lot of online and there's a lot of problems still facing us. So with that, if the consumers don't spend and they're really hanging on to their savings, this is one of the highest savings balance we've had, I think, from World War II on. It has been tremendous because people are, again, they're not going to the movies, they're not eating out, they're getting used to eating at home, they haven't been driving or traveling, there's no leisure. So the money is being saved. The question is, when are they gonna start shopping beyond the necessities? Although that auto, especially the trucks, they look good, but we are not out of woods. The last but not least, I think, is the sovereign risk due to all these government debts expanding. This is, I mentioned again, we are, the government is providing all you can drink alcohol. And, you know, it's free, we are drinking, but the after effects are gonna be devastating in my opinion. So right now, it's not just United States, I'm talking about globally. So they are pumping all this funds, the money, but what is at the end? 5 years, 10 years down the road, what's gonna happen? Continuing with that, I'm talking about, again, our deficit, the federal deficit. I just thought this is interesting from the dailyshot.com. The projections, what we've had it from 2013 to now, this is what has happened since March to May. Now, that's very alarming. Going back to the retail, so we go under the hood, let's analyze what is the components of the retail. The numbers, some of the numbers were very good. Obviously, it was beyond what the expectations were, but there was, it's called Quail Intelligence.com, comes out, analyzes these numbers. What you could see is it compares where we are today compared before COVID. So it goes from March, after March, March to May, oops. And we are actually 118% in the non-store, which is the, you know, online. So we're actually doing better than what we did before the COVID. And the employment is at 94% capacity. So that means there's still room for employment capacity. And what I mean by that is the difference between this and the employment capacity. So from that point of view, there is a gap, and that's why we're in the green. And that's a good sign. Then we look at the food and beverages. We are, again, the difference, we're at 18%, the building materials. And then you can see now, after about 5 different parts of the components of retail, things get a little uglier, and then we get really bad. And basically our health and personal care is the last really green. But then furniture, motor vehicle parts, food services, the capacity was 59, the sales were 59% capacity, now we're at 70%. They have to let go. They have to, they don't need these, unless this expands at this moment. These are the things that we look under the hood. The clothing, I mean, you can all agree that, you know, that the retail stores, you know, brick and mortar stores, they are really, they had difficult times to begin with, and now this is where we are. So they have to cut another 28% of employment to get where the needs are. So this is what concerns me. We have to make those moves. This one also is concerning to me. These are the wages by percentile, and Economic Policy Institute comes out with these numbers. It goes up to 2018. And as you can see, the 25, that means the high 5% of earners, this is their average income from 2000 to 2018 for hourly income, right? So they make $63 an hour in 2018. The bottom 10% of our population, our workers, they made $9.97 an hour. The 20% was $11.91, 30th was $13.91, and around 40th was the $15.94. So almost 40% of, as of 2018, 40% of our workforce were making about $15.94 and under. With unemployment wages, is assuming they're getting this, the minimum, that's $600 a week, and it's a 40-hour week, you're looking at about $15 an hour. So in reality, it's gonna run out in July 31st, and after that, you know, who knows what's gonna happen. So these people, if I am about 40% of my workforce is making more money, sitting at home, not doing much, being online, watching Netflix maybe, they really don't have any incentives to go out and at this time to look for a job. So what is happening is that again concerns me. Let's say about 35%. And what will happen when the unemployment runs out? So right now, again, the Fed is feeding everyone. We are, you know, doing well. Our savings rates are up. We can, with low cost, again, not traveling much, no gas, not much paying for gas, which that's changing. I'll discuss that. So these are some of my concerns. The other thing is I looked at the recovery tracker, and you can see the different, again, elements of our economy. The best returns so far since the March 23rd bottom is the financial, which is the stock market, really. So the actual recovery index, we are only in this almost 60% or 65% capacity. So we still have rooms to go. So we are not where we were in the beginning of the year, and that's what we need to go. So another concern, manufacturing, and I went back to 1980s. Every time we've had, as far as the weighted average of the manufacturing contracting, this is about 100%. It takes a long time to come back, and that's what we are again right there. So although now here we have the service industry difficulties, and then we have the manufacturing. But the bottom line, after saying all that, is stock market doesn't necessarily equal the economy. stock market looks for opportunities. Stock market looks for, not sorry, the money looks for opportunities. They go find where is the best yield for the risk that they're taking. What is the highest yield? And at this time, there is really not much alternative for the stock market. So the Fed, again, funding over $5 trillion and more is coming. All around the world, all the governments are doing the same thing. Fed is actually being pretty active in the market. All this money has to find its way. I mean, bond is the security, but when you have a differentiation from the yields of the Dow Jones and the S&P, much higher, almost 4-to-1 to 10-year notes, obviously there is a room for the stock market. So a lot of money is following the small market. So that's why I mentioned it's not just about discounting mechanism. You know, the thoughts are by the third quarter and definitely fourth quarter, things are going to get back to where they were. But at this time, if we see this this connection, this is the reason. And I've said it many, many times, we don't fight the Fed. You just have to be selective. You have to, these are good times to be really finding values and being I mean, for me, the trading has been pretty rewarding, especially at these times. But even as an investor, you just want to find the values, and there are some. So basically, that's why I put that not all the time. What I meant by that is stock market is not equal economy all the time. Right now, it doesn't equal economy. Before I get to actually the markets, I thought let's start with the indicator of the week. And as you know, I'm very much into mathematics. You know, my background is that. So I look at the different factors, but I like to see some hard facts before I invest or trade. In the past, we've spoken about Fibonacci's. I've talked about Ichimoku, Shimoku, clouds, and how I use them. We talked about Keltner channels. We've talked about moving averages. So these have, first of all, visual effects, but also they have numbers behind them. I use linear regression lines a lot, and the standard deviation from that, because they do have the probability and mathematical background. And that's what I think options trading is fascinating, because if you learn the language of options, and if you know what is the mechanism behind options trading, usually it's actually more rewarding than stocks. With stocks, you have a lot of variabilities. With stocks, you have a lot of components that is very difficult to quantify. But with options, because being a derivative, mathematically, you can do things. The same thing with futures also, because there's just limited number of, let's say, commodities and let's say financial instruments. If you are a good manager and you're disciplined manager of your trades, those can be very rewarding. With stocks, is very difficult because, again, you have earnings coming every every 3 months. You have macroeconomics. You have the CEO does something silly, and all of a sudden the whole company has to pay for that. So there's a lot of decision makings going to that. That's what, again, I like mathematical oriented because I like the visual things. And this week, the indicator of the week is the Bollinger Bands. It's very similar to the Keltner bands that we spoke in the past. Keltner based its decision making on average true range, and they used bands. Bollinger Bands uses the moving averages, and basically it uses standard deviation. For some of you remember from past high school or college, it's the statistically, the standard deviation is a variation, the square root of the variability around the moving or the averages. So Bollinger Band uses 2 standard deviations. So in a nutshell, John Bollinger developed this in 1980s, and basically he used, again, wanted to see the variability and the volatility bands around a specific moving average. Now, majority of people, they use the 20 bar moving average or 20-day, and they use the 2 standard deviations. And what happens in the futures, on the other hand, I prefer, and I know a lot of futures traders, we use the number 18. And they're pretty similar, but 18 works a little better. But they follow the same concept. The concept is that with the 2 standard deviation, the prices are contained 95% of the time within those bands. And that's the definition of the 2 standard deviation. If it was 1 standard deviation, it will be 68%. If you go to 3 standard deviation, then 99.1% of the prices will be contained inside those bands, which I've used those bands before. But main thing is the 2 standard deviation. So that gives you the odd in your favor, knowing that if a price moves out of the bands, they're only going to be out 5% of the time. And again, with the laws of universe, things come back to normalcy. So what happens if they go outside the bands? Generally, they come back in, or at least retrace back, or kiss it and come in, and then maybe they go out again. But either the bands have to expand to hold them inside, or they have to come back in. So this is what I use. I use the combination of actually Bollinger Bands, Keltner Bands, and momentum to sometimes find out what is happening with the markets. Is this a good time to go in? Is it a good time to buy options on this stock? So rather than just giving you, like a graph, I thought I'm going to analyze the markets of last week so we could have something feasible to follow. And with that in mind, I'm going to go to the markets using the Bollinger Bands to analyze where we are. Before I do that, I just want to show you what happened last week. We only had one sector in the green. The rest, everything was in red on Friday. And but it was a good Monday and Tuesday, and then Wednesday, Thursday, Friday, things really had a wide range, but it was like up and down. And I've never seen so many gaps, and that's talking about overnight. We gapped up, we filled it. We gapped down, we filled it. And in the future, I will definitely talk more about the gaps, especially for indexes. In the futures market, it's very rewarding to know about the gap play, and the odds are between 62 to 82% in your favor, depending on what day you're using it and what kind of it's an option expiration. But that's a class on its own. But anyway, it was a wild week, so these numbers are not really fair estimate of what happened last week, because it was really wild ranges, but it went up and down a lot, but it was a small closing. So, but I thought I'd share that with you. Let's go to Bollinger Bands. I use futures, which you have access to. The stock charts allows you to have, look at futures. Finviz. Finviz, you have the access to the futures market. You can look at the charts. There's no fee. I use TradeStation. I use Thinkorswim from TD Ameritrade. They all have, they have charts. You can use anything that, any indicator that you want. But I'd rather look at the futures market because they're almost continuous. So they're out about 23 hours a day. They open till Friday afternoon. So this is end of the week, and this is where we are as far as what we are as far as Friday. So you can see, I also put the Fibonacci number from the low of March 23rd to the high of, beginning of June, when we had a nice retracement, and we are this fantastic run from March 23rd. So basically last week, if you recall, the previous week, we had that big Thursday drop after Powell's speech, and we went, and so these numbers, I use, again, Fibonacci numbers from my moving averages. These are exponential. They're 8-day, and then we have the I have the 21, 34, and I have 55 days. But you could use 20, you could use 50, they're pretty similar. So we went and we stopped right at 34-day moving average. We bounced back last week, and then overnight we went and actually, if you recall, I've said about moving averages. It, moving averages, what happens usually when we break in short term, when we break one, let's say it's 8 day or 8 bar, we'd like to go and kiss the other one. And like 8 goes to 21 or 20, the 21 goes to 34, and 34 goes to 50 or 55. This is a tendency of the market. If it bounces back, then that negates that. So here, this day was overnight. We went below 55, but we actually closed above the 34 and the 21. So that gave us the comfort knowing that, okay, well, there is a bounce, and that's what the next day we were up. Right now, as of, again, this is Friday's close, we are sitting right at the 21-day exponential moving average as a support. We will discuss that, I mean, with my other, as far as analysis of the future charts, we will get to that. But we also, you can see, we came to that, the 23.6 retracement, and that's where we've been really, for 3 days we were there. And so this kind of where we are, there was a selling pressure on Friday, and I will go further discussing what happened. Here's the Bollinger Band for the same ES reading that we had. So I use 18-day moving average for the Bollinger, and I use 100-day. The reason we use shorter time frame, futures market, as you know, they're finite. You don't go back. They do have, like for instance, for the ES, and we reviewed the futures market, what it was. It was a derivative market based on the underlying instruments. And what it is, basically, because they have finite, we just rolled to September, and then we have December coming up. We use a shorter term. And these Bollinger Bands, this is the lower band, and this is the higher band. And what happens is, these bands kind of contain the prices, as I mentioned, 95% of the time. Now, this is where there's some misconception about the Bollinger Band. So what is told is Bollinger Band, if you hit the lower band, then we are oversold, and then the markets are going to go to the upper band. And that's how you can use the Bollinger Bands. But in reality, what Bollinger Bands are, again, they show you whether the volatility of the markets, where they stand. So when you have narrower, and if you recall in May and June we were discussing, the bands were getting really close to each other. That means the energy was being coiled in. The bands are getting closer and ready for an action. We didn't know which way, which we could use a momentum indicator to find out which way the markets were thinking. But at times like this, then the indicators work that if it hits the lower band, there's a good chance it's going to go up to the upper band. But when it starts expanding, when you have all that energy which you have been coiling and conserving, then the bands open up and the prices go with that band. So that doesn't mean if I hit the upper band, I'm going to come and go to the lower band. The momentum is too strong to negate that. So we just continue. The only thing is, we do not stay outside the band. The maximum we can stay is 5 days. I mean, if you're an odd maker, and that makes sense because it's 95% inside, so the 5 bars is 5%. So as soon as the second bar or third bar is staying outside, at least you know either you have to sell, or, I mean, you don't want to short it, but at least you know if there is that odd, maybe you can sell it and then come back. And usually when they come inside the bar, they like to go to their 20 bar, especially using stochastics. Stochastics is another art that a lot of people say, oh, if it goes over 80, for instance, oh, that's overbought and it's time to get out of it. There's, over 80 doesn't mean it's overbought. Basically, what that means is a lot of momentum, there's a lot of power in this buying. So as long as it's over 80, I'm staying in it. The time that we'll get out is when it goes below 80 and then starts going down, and then around 70 or 70, between 70 and 80, that's called overbought, and that's where the selling pressure would be. But if it's a price is above 80, that doesn't mean it's time to sell, and that's what you could see. Even on the way down, you could see we will go out of the bars and then we will come back. We will go outside the bands, we will come back. So the markets do not like to stay outside the bars. So how can we use to our, what we learn to our advantage, especially in option buying? So if I'm gonna buy options, obviously options, and we've talked about that in the past, options depend on 5 things, but the main 3 are the price, exercise price, which price we're gonna purchase and how far it is away from where we are, and how much time. Obviously, the longer the time, the more we have to pay premium. And the third one is the volatility. The higher the volatility, the more expensive it is, because as a market maker and art maker, I want to make sure things are on my side. So if something is unpredictable, say I'm a biotech in the phase 3 of something or phase 2 of something, and we don't know what the numbers are going to be, there's that big odds probabilities, very wide probability. So what Bollinger Bands allow us, when there's a predictability, when the bands are narrow, that means the volatility is low. So maybe that's a good time to start buying options, whether it's call or put. When the bands are very wide, that means the volatilities are huge. So it might be the good time to start selling puts or calls. So that's where the Bollinger Bands can be very helpful. Besides the direction, if it's oversold, so we use the stochastics, I use if it's under the moving averages. Now, what happens, this is another tool we use, is if it's outside the band and it's embedded, but if market goes below the statistic of 80, usually the market likes to go and kiss the 20, or in this case, 18 moving average. So these are some of the things that we use using the Bollinger Band. The big players also, they look at the 100-bar moving average, or in this case, 100-day, as a support or resistance. So as you can see, we came and hit the 100-day, and then we bounced back. We have just broken under 18-day. I will discuss it a little more, but right now, what I can see is a wedge from the classical technical analysis, which could go either way, but right now the momentum is downside. On the other hand, let's look at NASDAQ, which has been the strongest of all the indexes, and for a good reason. Basically, what we can see is, look at this. The band was right around here. First of all, this is where we were with the stochastics. Now, some people would have said, oh, we are really overbought. Well, we closed above the moving average. The bands started moving. The moving average started nice slope up. This is not a selling. There's no selling pressure. There's a lot of momentum. And every time we went up, we were contained inside the band. So we've been contained inside that band, and we've been over 100-day moving average. We've been over 18 most of the time. And after that, again, big sell-off. By the way, this is a weekly, so it's even, I use it on a weekly basis. So I just want to show you on a weekly, you would have been a buyer till we broke below this the 80. But as of now, the momentum is still in our side. So we don't have a selling, at least at this time. We are within the bands above 80. 18-day moving average, 18 weeks. This is on a weekly basis, 100 week. So the only concern I have is these three tails. We call them wicks on the candle, which we'll discuss a little more. And this is Russell 2000. Russell 2000 has been actually the weakest, but they were the strongest with the bounce when they did. They had a very short-term box, but now we went under the 100-day moving average, and we have broken 2 candles below the 18-day. So we've, as you can see, we became oversold, and then we went down. So the stochastics, they look weak. From classical, again, I can see a little head and shoulder, but I don't count too much on these patterns. I rather use the other dynamic indicators. With that in mind, let's also look at some different charts with the Dow Jones Industrial. This is from the stock charts. As you can see, I mentioned last week, we formed an island, and it's difficult to go fill that gap in this island. So this 200-day moving average has been strong resistance. So this is where the Dow is. There's a fight between the 200-day and the 50-day at this moment. On the other hand, you can see the S&P had a nice bounce last week, and then we're sitting right around the 20-day moving average. But again, I see there's a little wedge being built. The Russell 2000 could not hold the 200-day moving average. We actually even broke below 20 day. We went back up, hit the 200, and we're just sitting on the 20-day moving average. I talked about last week on the risk on, risk off. This is a transportation ETF. Again, the same story. The 200-day could not hold. We tried to hit our heads against it, and right now we are right around the 21-day. Financials, again, the S&P needs financials. The same story with the Fed coming up and saying about the bond, as far as they're going to support the low rates till 2022, even 2023. So the financials could not even make the attempt, but they could not break over the 200. On the other hand, the VIX, the volatility index, has broken above the 20-day moving average, and it's in 50 days. So it's telling us that the volatility is here to stay. I mean, we've been around 10 and 12 for the longest time. The 15 has been the biggest, but as long as we're over 20 right now, the markets are not out of woods. I also look at the number of the S&P stocks who are over their 200-day moving average. At this time, only 41% of the stocks out of 500, they are above their 200-day moving average, which tells us about 300 of them, they are 280 of them, they are under. There's a reason I want to talk about Apple, because last week I mentioned about the components of Dow Jones and the NASDAQ and S&P. And we mentioned how S&P and NASDAQ are market cap, and the Dow Jones is the price. They're using the divisor. And Apple plays a big role in all three of them. Microsoft, Apple, we go in the Facebook and Googles of the world. So if Apple gets tired and starts selling off, or if the Dow Jones on that end gets tired and sells off, this is the stock we want to watch, because it's going to pull down everything else. S&P is not going to break down, although we talk about the financials, without effects from Apple's and Microsoft's and Google's of the world. So basically, this is the stocks that you want to watch, the big horsemen, the FANG stocks. And they're the one who have been really holding the market in a sense. And that's why I want to show you the 200-day, that the stocks over 200-day. When you have almost 300 stocks below their 200-day moving average, but S&P is sitting above it. There's something is not right. So, but the markets will not go down a lot without these stocks, which comes back to economic activity. Of course, a lot of you have been following me, from March. I've been, discussing the UGA, which is the ETF for the gasoline, and it was a buy at 9, 10. And since April, since May, I mentioned, people are not gonna, doesn't look like they're gonna fly. A lot of people will be driving. And today, actually, I was driving on the freeway, and one of the tests that I use is in the freeway, how many times I put the foot on the brake pedal. And I don't think I've had to brake so many times in the last 3 months as I did today. So the freeways are getting busy. Obviously, the children are out of school, still not many people are flying. The RV business is off the roof. I mean, if you are a Winnebago or Thor Company or the CWH, this is like thriving, and people are getting on their RVs and just traveling the country. So obviously, there's more demand for the gasoline. And obviously, we had a bounce in the oil market, but this is kind of this icing on the cake. And we've been over this 20 moving average. You can see from the beginning of the May, we come and kiss it, and then we just bounce. So it has been healthy recovery on that index. I also look at copper. They call it Dr. Copper as a health of the world economy. As you can see, so there is things like this, that the copper really bottomed in March of 2020 on the 23rd. And what we did, if you recall, we did a Fibonacci analysis of a monthly of copper, and we hadn't been this low since December of 2008. So I mentioned this was really good time to maybe get into companies like Freeport-McMoRan, because the cost of just operating was more than basically the cost of copper. So they would just close their doors. So there has been a nice recovery in the copper. So that tells us a little bit of health economy. We are not using as much copper before, but still it shows us there is some activities which goes along with the lumber. And lumber is, for me, is also talks about the economy. So at this moment, so you can see there's some reasons for some of these economic stocks being up. The home builders, for instance, the XHB has been doing well. When I was in Florida, I could see a lot of construction, but majority of them were like apartment buildings. So a lot of these malls probably going to be changed to resort apartments, because I don't know how many people are going to be able to purchase houses with the way not the economy. I don't think it's going to get back to the full recovery till probably end of 2021. US dollar obviously plays a big role. It affects the price of all other commodities, but it talks about the health of the country, the currencies, and dollar had a big drop, and then we've had a nice recovery since then. Let's talk about gold, because I mentioned about the opportunities. So stock market has offered the best opportunity in the last few months. The money has been going on in there because of, again, thanks to Fed. But also you can see the gold has been in a channel or in a box since really beginning of April, and we're still there. So every time we go to around 165, 167, the buyers come in. So we are in a box, and this might continue for a while. We are above our moving averages. There's a convergence, but obviously people are concerned. They are using gold not as an investment at this moment, but more of a hedge. There is more demand for the gold bars. So this is because I look at the premium have been really high. So it still shows there is a good demand. Again, people are concerned. So this is one chart of gold, but also we look at on a weekly, as you could see, again, we went above the Bollinger Bands and we came down. We went again above it and we came down. So we still above 18 days. So there is no sell signal from this chart. We did close on a weekly basis, went below the 80 on the stochastics. But as of now, just basically when this happens, the market likes to go and again kiss the 18-day moving average. So there's no sell signals on gold for me. And on a daily basis, the same thing. We had hit the 100-day moving average. We came back up. So basically, we had a nice day on Friday, and that's where the gold is. We had spoken about Bitcoin. I thought, you know, with the halving going on last in May, the Bollinger Bands, as you can see, they're narrowing. So this could go on a little bit, but then the big move could happen. So right now we are below the 18-day moving average, above the 100-day. We are just consolidating. So let's see how that goes. So I'm neither, you know, at this time in the short term, you're not a buyer or seller. I found this chart interesting, and I've talked about it again, talked about the risk on and risk off. On the left, this is a chart of, again, the S&P futures. This is from beginning of May. And you can see movement in the red bar and the green bar. On the right, I have the chart of Aussie dollar. So Australian dollar versus US dollar. And as you can see, the Aussie dollar kind of leads US, and this is our risk on. So basically, I mentioned in the morning, one of the routines is to watch. We can go on Finviz. You don't have to have TradeStation. Just look at which Forex or the currencies are leading. Just to have a confirmation. Remember, it's like we are the West Coast. It's like 5:30 in the morning. We can take a look at it. 6:30 when the market's open. Look at it. The first hour of the day, you can get a good picture. So around 7:30 to see if there's a confirmation, if there's a divergence from those. So if the Aussie dollar is up first thing in the morning, that doesn't mean you have to jump in the markets. Basically, it just gives you a heads up to something to watch. And as long as there's a coordinated effort with everything else, then the odds are in your favor. But 6:30 and on, that's when the action happens. I never get in the market at 6:30. I've mentioned it. At least I give it a little bit of time because, again, a lot of investors, they get the news, they read the whatever news reports they want to see, and they get excited and they can't wait for the market to open at 6:30. And usually it's the false move. So I'm pretty patient, and that's what I want you to be. One thing I mentioned about the education, remember, I use the analogy of sports. This is a process. You have to have a plan. You have to have a discipline. You have to have a routine. I mean, my routine, one of my friends came over. It was wonderful to have him. We were together for 2 weeks doing the trading and learning about investing. And he noticed, I mean, my routine is pretty boring, but it's very, very disciplined. It's the same routine every morning. I'm up about 4:30, 5 o'clock in the morning. I follow the same things. It's a system. I don't, around 8:30, 9 o'clock, that's when I have my breakfast because, the markets are closed. I don't do much between 9 and 11. Why should I sit and just look at the, my terminals, thinking, or my monitors, thinking that something magical is going to happen? Take my time, but I do a lot of preparation the night before and in the morning. So make sure you have your routine. This is something new that I want to tell you because the option market makers, they're the ones who price the options. So every week they come, and every day actually, this is one of the ways they price your option that you're buying or selling. And they have something called this expected move. Every stock has it. So I thought I'll give it to you rather than you going and search for it. So last week, the option, again, the expected move, and these are the weekly options, so this goes for the next Friday. So from Monday to Friday, the last week they thought the market will move 125 points, which means it could go up or down, but that's the movement. This week still is pretty volatile. I mean, we were in the 50s and 60s before all this happened, and close to 70 maybe, but never been, we've been just being around this. So as long as you have these triple digit, the volatility is not going away. So we are, for next week, they're projecting that we will have 112.7 points for the S&P cash. Let's talk about the trade of the week. And I thought it would be interesting to use, again, the Bollinger Band, since we're on the same theme, and find out, I had a couple of trades, which I had actually quite a few trades, but I thought it's timely to choose a couple of them and see, or two or three of them, what were my thought process, why I got into this trade, and if it worked. So one of them was, it was on June 14th, was actually at night. Again, it's a lot of activity going on overnight, overseas. It has become really a good trading environment. Although the volume has been pretty low, it's been okay. I had mentioned before, Sunday evenings or afternoon used to be my best trading when I was doing grains. It was a lot of predictable patterns with the soybeans and wheat. It's not much so now. I mean, it used to be nice to have the pits and, having the open cry, at exchanges in Chicago. But nowadays, it's everything is electronic. So, but the grains haven't been as exciting as they used to be. So with the financial instruments, means there's just so much activity there. You really don't need to go there to do grains. But this is what I saw. It was about 10 at night, and I had noticed this was the Russell 2000. It's hitting its 8-day, and it was, the 8-day exponential, and there was a resistance there. So I go to the shorter term, and I notice on the 60-minute, and that was like, again, about 10 at night. So right around here, it's a 200 bar resistance. And at that time, I thought, well, we're breaking down. So this might be a good time, maybe have a short play on Russell 2000. So Russell 2000 moved to ICE. Before that, it used to be TF was the symbol, and every point was $10. With moving to ICE, it's every point is 5. So I decided to play a futures trade on that, and it was about 10 something in it. So I got in, and then I was looking at the moving averages, and basically it was a 10-point move in a matter of, I don't know, 20, 30 minutes. So this is overnight, and it was just, I felt, there was a heavy resistance at the 60 minutes. 1450 was a big resistance, and that's where I got in. And I had to go to bed. I think I just didn't want to put any more trades. I ended up going to bed at like, I think 1 in the morning anyway, but I ended up just at that moment, I will be sleeping. But anyway, so this was one of the reasons. So we did the Russell 2000. This is on 233K. The other one I did is an option play, and it was on Microsoft. As you know, Microsoft have been very strong. I was a buyer right around March, end of March. I thought there's a lot of good things were happening with Microsoft, especially with their cloud and a lot of moves that they had done. So last week, actually it was June 4th, week of that, around beginning of June, I noticed the Bollinger Bands are narrowing. Again, this is another Bollinger Band, and this is the momentum. Momentum was going up. We were just around that 18, in this case it's 20-day because it's stock. I use the 20-day moving average. As you can see, we are really narrowed. my bias was up, and this is where I saw it was a red candle, but it stopped right on the 18-day, and then we had the reversal. So at that moment, I thought, as soon as, again, with these bands, we move and momentum moved up, the bands are going to expand. So basically, I played a bias on option bias on Microsoft. Again, Microsoft was quiet because it's been pretty wild ride, but there was something going on. So again, with the bias being on the long, I could play rather than just, I didn't play rather than spread and other things, or I could do straddle, for instance. I just went pure directional. One thing I did, I bought a call. I bought a call at out of money at 187.5, and at that time the stock was at about 183 or 4. And I also sold a put for 167.5, which was way below. It was right around 100-day moving average. And for me, I thought even if I got exercise selling put, I wouldn't mind owning Microsoft. And that was June 19th. So here's the results. So this is my put. I sold the put here. And when you sell the put, you're hoping that the market is not going to hit your 167.5. And this was a June 19th. So basically, as long as it stays above that, whether it's dropping or going up, as long as the odds are in your favor, you will win. So we bought it at this area, and we covered at like 1 cent. So I kept my premium. I was a rent collector on this. I was a casino basically, and this was my call option. I bought it about 190. Again, remember this is where the Microsoft was. So bought it at 190, and I was ready based on my other indicators. I just got out of it on the 17th. As you could see, it actually did go up. I could have made a lot more money, but it was about 590, and I got out and could have hit over $10. But that's okay. I mean, again, I've said many times, you do not look back. There's no regret. You have a discipline. You have your priorities. I usually put when I have I had 2 different contracts here, but I usually put multi-contracts. Every one of them, when I get in, I already know when I'm going to get out because I have a clear mind. But when you get in and then you decide to change things, you become very emotional. And that's not the good way of managing your risks and your targets. Every week again, I like to go back. We've had some really good websites. So I am thinking that this week, we went to a dividend investor last week. One of the best ones that I found out is at barchart.com. I emphasize Finviz because there's so much to do with Finviz for free. There's stockcharts.com. They have great, actually, educational tools. They have great charts. And again, that's for free. Barchart is also free. You could, every one of these, you can be a premium member, by the way. So you have a little extra benefits, but just a basic subscription, excuse me, to them is wonderful. So there's a lot of good charts with barchart.com. I think you will enjoy it. It is free. And what happens is this is something that you could add to your Finviz and you could add to your stock charts, plus other ones. We talked about Guru Focus if you want to see how you can maybe price in as far as using the discount cash flow, or you look at the price to sales, what would Ben Graham do, what is Warren Buffett and let's say Ackmans of the world, what are they buying, what are they selling. That's a good, again, good one. Investors Business Daily, but I think you will enjoy this barcharts.com. So As Sean mentioned, so I'm going to take the last few minutes just talk about the changes we're going to go through. As all the videos not available on RM Smart Investing YouTube, which I put the link. So once you get the hard copy, you can even just link on it. But you can just search on YouTube and do that. There's quite a few videos there. You can, if you like, you can subscribe. Um, if you liked the video, obviously it's always appreciated you put a like sign on it if it's worth it. Um, there's also some videos from the past. You you can also forward to your friends. This is going to be public. So as you know, our group has been very small group, only by invitation. So we were trying this for the last 12, 13 weeks. I hope you've enjoyed it. This has been, again, it's been a wonderful journey for me. So I'd like to continue with this. And as we decided, beginning of July, we will make it subscription only. And at that time, our YouTube channel will be unlisted, or it will be only by invitation. All the people who are the members of the channel will have, or the group, they will have access to that. I will also would do extra videos or learning lessons, whether it's the indicators or it could be option strategies or maybe commodities strategies. As I mentioned before, I started writing a book on commodities in 90 minutes, which I think will be very helpful. And we do that on options and emerging markets and technical analysis and currencies. So we will continue with that. So we're more of an educational YouTube channel, but it's going to be only available for our members. For the public, I thought, again, every 4 weeks, we probably will just continue to have, maybe have one extra presentation which will be open to public, and that will be a Q&A. With the Q&A, this way you could have your, maybe submit your questions in advance, and what will happen is at that time, we can just discuss the things that is more applicable to majority of people, but also it will be good interaction with our members, because some of you might have some input which I love to hear. So that would be a good time to basically have it open to the public. Maybe we have friends that they want to try our membership, they can come and join us. And basically that's how the future looks. As I mentioned a few months ago, I was supposed to do a investment symposium in Qatar. We got our speakers, everyone was ready, and things happen beyond our control. So obviously it didn't happen, but it will be, once it happens, I will absolutely let you know. And that's where we're trying to take this globally. We do have presence in 23 countries right now. So again, my whole purpose is to have that education element. It's something that I've enjoyed all my life. It has been a privilege to work with so many people. And as you know, I love soccer. I've coached soccer for 40 years now. And I've really enjoyed it to share with the young kids and older kids. And now that they have kids older than me, some of them. But anyway, it is a privilege to be part of this group. So that's the changes we go through. We will be in touch this week, get the logistics going on, how we can sign up and what we need to do. Next week, most likely will be our last free presentation. And again, if you have any friends, please, you're more than welcome to invite them. And after that, we'll continue our journey and hopefully expand it, and hopefully we'll have more educational, actually specific videos. And yeah, that's basically that's how our future is looking. As I mentioned, these are exciting times. I mean, July we're gonna have the earnings coming up, and there will be some more movements there. End of July we have a lot of numbers coming out with the employment and expiration of the unemployment checks. With what happened last week with North Carolina, South Carolina, Florida, Arizona, Southern California, the markets are jittery, but there's just so much money from Fed, and they got our back, and they're not shy about it, that you cannot fight them. So you just have to be selective. Just protect your profits, be in the market, but just know that things could happen, and just protect yourself. All right. With that in mind, I think it's finished a little early, so we have more time for Q&A. Sean, you can open forum the mics, and if there's any questions, I'll be more than happy, or any concerns, I'll be happy to answer.
Sure.
Thank you, Sean.
No problem. I think most people are muted by themselves. Just unmute here. And
Okay.
the people I muted, I already unmuted. Thank you.
Okay.
Hey, Ramin.
Yes, Henry.
Question about the Bollinger Bands.
Yes.
First of all, it's Bollinger, not Bollinger, right? I hear some people pronounce it Bollinger.
Good. Well, I know John. I've met him, so we call him Bollinger, but yeah,
Okay.
it could be Bollinger. But yeah, sorry about that.
It's just no, it's okay.
Yeah.
It's just a
Yeah.
curiosity question. But do you use Bollinger Bands differently in different markets, like in a bear market versus when? I've noted that if I look at the chart at the Bollinger Band and the moving average is moving up, then I can predictably make money when stock, goes below or touches the lower band. And, if I look at the stochastics, I get a confirmation. I can make money predictably, but if lower band is moving down or the general direction is down, then then you lose money. So
correct. So what happens again? The original indication was, first of all, each market behaves a little differently, and I've mentioned, like, even if Fibonacci, even moving averages using oscillators, some markets are they are trending markets. Some markets are range market, like, when we look at euro or we look at, for instance, gold, they're more trending. Once the trend starts, they usually like to go, and then when it stops, they just become range till they go to the next move. So they're more predictable. With the Bollingers, as you said, it is one of the misconceptions. Okay, it hits the lower band, then it's gonna go back to hit the upper band. Not necessarily. So that's what you have to look at, the pipe, in a sense. When it narrows, as I mentioned, it kind of, the energy is being squeezed. So there's something kind of big happening soon. We don't know which way, and that's why you use a momentum indicator. And momentum indicator usually gives you the direction of the movement. So when it goes down, and if the momentum is down, that's not the time saying, oh, it went outside the Bollinger Band, well, let me go long. No, it basically tells you there's something happening. And if you are, let's say you were short, maybe you want to cover at that moment because it's going to come back in. But that doesn't necessarily mean that you have to go and buy because it's outside the band and it's going down. At that time, when it's expanding, that means more energy is coming. So you're absolutely right. But especially when it's expanding and going down, it's almost like catching a falling knife. So you don't do that till you get stability. So when the Bollinger Bands have really expanded, then they start, like you mentioned, like the moving average starts flattening. Let's say they went down, now they're flattening, the Bollinger Bands come closer, momentum is moving up, and when it goes above zero, then that's the time to start accumulating. But going down, obviously, you should have other indicators, so for instance, where your support zones are, and if you use other moving averages. But more people make more money in falling markets than going up, because going up is gradual. Falling, the old saying, it's like an elevator going down and taking an escalator up. So basically, going down, if you hedge yourself, you probably done well. But just make sure, because of the volatility, that's Bollinger Bands are just giving you some kind of just the limits, but that doesn't mean they give you the confirmation of when to get in. It just gives you the heads up. So, but yeah, I mean, you would have seen in March how many times the big bars too, they're not small bars, how many times they went in, but they didn't stay outside too much. The other thing, studies that we've done, again, that was a misconception. Okay, we use a 2 standard deviation, and that works well for everything. Some of the markets that, especially in ags, I've used on a weekly basis, the 2.5 standard deviation worked better than 2. So let's say it contained 97, but it doesn't work for everything. On a minute by minute, or let's say if you did 5 minute, it doesn't work as well as, let's say, if you did 30 minutes or 60 minutes. That's why I use, for instance, Bollinger Band. I definitely use daily because a lot of people follow that. And also, I like to use, like, say, 60 minutes. And the weekly ones, I've tried, depending on the market. So you could use 2 standard deviation or 2.5, and then take it from there. Sometimes even you use 1.5, but it's all the statistics, right? So I would combine this with Keltner channel. I would definitely use Fibonacci, and my favorite is Ichimoku, because Ichimoku gives me the support and resistance and more of a projection of what's going to happen next. We will talk more. I mean, as I said, I will do more videos on Ichimoku, and also like Fibonacci extensions, how you can project the future price on using Fibonacci, and how to read Fibonacci basically to have the biggest advantage. So, but good question, Henry. Thank you.
Just a quick follow-up on that.
Yeah.
So again, if the direction is down, it will most likely continue to follow that lower band down, but it seems like you can still make money if you just hold the positions short.
Correct. So it all depends. So remember, if you have that momentum going down, and then what you could do, I mean, if you're brave enough, you use that candle. So your stop loss will be, so let's say a candle is a red bar, and then you say, well, it's going down, but then the other candle came in. So what you have to use the high of the previous candle as your stop loss. And that's when you can continue. And then you could have a trailing stop. So it could be the previous bar continuously. And that way you have your loss in place just in case it turns around, has a big whipsaw. But if it doesn't, you are going to stay in that position on the short side of it till it flattens out. So you could use that. And then I will use the 60. So I usually do long, and then I go smaller interval, and then I use, let's say I go from daily. On the currencies, I go to 240 minutes or 120 minutes. But in the stocks, I use like 60 minutes, and then you can go to 15 minutes. So you just want confirmation. So if everything aligns, then you just stay in your trade. But it is very difficult sometimes when they're just really falling fast. And I always use that May 6, 2010, the flash crash. I was in the right place. I shorted the market. We had over 1,000, and I was in the futures, and S&P, the mini S&P was going down like crazy. I couldn't get out. I had put my, and by the time I got out, it was like we had already bounced 400, because all the institutions, they were ahead of me. So I never got covered. So these are the things, unfortunately, when things go down, even if you're in the right place, sometimes you don't get filled. But
Okay.
Yeah, that's what I would use. I would use daily, and then you get confirmation from your shorter term Bollinger Bands.
Okay. Thanks.
All right. Good. Any other questions?
Hey,
Any
Uncle,
comments? Yes,
I had a
Ken.
couple questions, if you don't mind. The
Sure.
first one's a pretty dumb options question. It's about calls.
Sure.
What would prevent someone from buying a deep in the money call and then immediately selling? Would that net them a profit or?
Sure. So you have to remember, when you're in deep in the money, one of the most important things you have to look at is your delta, and delta
Right.
gives you the probability that this option is gonna expire in the money or at your exercise price. The second thing is also delta tells you the movement of for every dollar that the stock moves, how much your option will move. So if you're deep in the money, you're probably very close to 1. So let's say 0.9 or 0.95. So the danger part about, not the danger, but when you're really deep in the money, it acts like the stock. They're pretty expensive. So if you're deep in the money, if you have the capital, that's fine. If you don't, then that's what people usually do at the money or close to the, or in the money, but close to the strike, what the price is now. The rule of thumb is, if you want to go in the money and you want to buy a call, make sure you have a delta of 0.7 or 70, because that means the odds are in your favor. So it's a 70% chance you will be right. When you go really out of money, and when you're down to 10, is option market. The market makers are not stupid. Their job is to take the money, and then they price it accordingly. So they know, okay, if they know that the delta is 10, unless you really have a hunch or you have something very special about the company, usually that's the reason they say the options, expire worthless or expire, which is also a false statement, because 70% of the option traders, they're out of their options before the expiration anyway, and the 20% they cover on that day, and then only 10% exercise it. So 20% lose the money, 20% cover, exercise, and 10% lose the money. So it's not really saying that all the options are expire worthless, because people do sell out of them. But yeah, make sure the rule of thumb is try to be 70, around 70 or over if you want to buy.
Okay, great.
Okay.
Thanks. For my other question,
please.
Considering how Florida had a recent spike of coronavirus cases, and it only seems to be getting worse, plus governor said that they won't be closing anytime soon, and plus that over 33% of the population is over 60, are there any good funeral home or coffin stocks that you recommend?
Okay. Actually, we went through this, God, a few years ago, and there were two companies. I don't have it if I'm on, and it's a kind of a morbid question in a sense, but it is a reality. So there was a couple of companies. There was one Canadian company which they own places in the United States. I have to look into that. I will. And in the long run, well, it's a steady cash flow, obviously, for them, but it is. I have to check into that to give you a couple of names, but we went through this about 10 years ago, but I haven't looked into that because there were so many other opportunities. But I will send you an email and maybe announce it. So yeah.
Okay, great.
Hopefully it won't be needed, but that's part of life. So.
Yep.
All right. Okay, Kenneth. Sure. Any other questions? Any comments?
I think previously the question about why don't buy in the money and immediately exercise to make money, it's because if you buy in the money options, you have to pay not only the price premium but also the timing premium, the time premium. So basically, if you exercise immediately, you are losing money. because you
Oh,
paid
really?
the time premium.
Okay, thank you.
Yeah, that's a good, exactly. Yeah, and unless it's like 101 delta, yeah, there's no, that's why it's like sometimes, especially depending on the stock, as Sean mentioned, you have that premium, and then on top of that, you have that spread that you've paid. So one of the things, I guess, this is a formula you could use where if you're an option trader, in order for you to find out where's your break even and how much money you have to, and that could answer your question, Kenneth. You look at the spread of ask and bid, for instance, and you divide it by your delta. That's how much the stock has to move just for you to break even. So if you paid this ask, and let's say it was, it was like $1 and your bid was 80 cents, there's like 20 cents right there. And if the delta is 8, the stock has to move up 25 cents just for you to break even. The other thing is when you exercise, there's still commissions you have to pay. So majority of people, it's just much easier just go buy the stock. You don't need to go buy in the money and exercise it immediately, unless it has really gone your way. So, the next weekend, and that's a different story. But yeah, you're paying premium for something you could have it yourself. So,
Nice.
Ramin?
yes, yes,
Hi,
Ida.
Ida. I have a question. I know you covered, you just said something that if you want a stock, just buy it and then play the covered call or whatnot, right?
Correct.
So there's no spread that I could utilize to buy the underlying stock when it's lower, besides naked put, selling naked put.
Selling naked put.
Yeah.
As far as the strategies, like just like buying it like inexpensive. I mean, the best ones, again, the naked puts are the most attractive one, and you have to
Dangerous.
qualify for that, and dangerous, right? As long as you have, good understanding and you have the capital, a lot of people can make good money on it, but that's why it's at level 4. But as far as like you just said, sometimes it's like outright buying the stock especially if it's a low price stock, that's the easiest way. Go ahead.
Go ahead. Go ahead. Sorry.
No, I was just saying the other way would be unless you play spreads,
Yes.
or you play like either did the iron butterfly, or you had like 2 legs and you got 4 legs. So maybe if it's going your way, eventually what you could do, you just get out of your, let's say if it's
like the long.
The longs, and this is the calls end of it, and then just keep your puts and have that part, and then get out of your put, then you end up just having naked, but then you have a lot of cushion. So even if it goes against you, you've already gotten paid, a lot of premium. So those are becomes more of a strategies that you kind of, it could be dangerous, but also it could be very profitable. So you could do that, but outright, I don't know.
Yeah, the reason I asked that, I have a bull spread for Apple, which I want to have.
Yes.
And Apple just went crazy,
Yes.
crazy. But this is not gonna expire till 2 weeks from now. So I had Apple long, and I sold a covered call like in 2 days, and it was so down, and for some reason it just went crazy, so they were called away. So I want to replace it.
Sure.
That's why I was playing that bull spread. So now I was thinking, because the short is 315, and as you know, Apple is about 350. In 2 weeks, I was thinking, you know what? I'm okay to own it at 315 if it goes 315, because I know Apple always goes up, because I have a few long. I just want to replenish the 100 I lost from the being assigned. So in essence, if I want to own Apple, potentially if it goes down 315 on the 10th, which it's a possibility because it's crazy, I could just close my long put to get some money, and then just wait for it expires. So at 315, if it goes 315 or below, I own the stock, correct?
Correct. So again, see, that's all that defined you. As long as you know your risk and it's defined, then the one thing I have to mention, you have to be careful on the underlying stocks they're using. I mean, with the Apple, you know, basically the bias is up. So when you do the, let's say, covered call, you want to make sure either has to go really out of money and there's still premium in it, because you know the bias is up. So you want to find some stocks that basically they've been volatile, so there's a premium on them,
Right.
at least, but they are not really fundamentally, you know, they like some of these economic sensitive stocks, they just went to nowhere. So basically some of them you could say, well, there's a 200-day moving average, like there's you did a Fibonacci and you did a lot of different, I did the Ichimoku. The odds are really against it, and they are, let's say we just used like the Russell 2000, hit the 200, moving, coming back down. So you would put like maybe $1 or $2 over 200, and that's what you could use. Apple, there's just so many things behind it that it is just so much momentum, so much money coming in. It has a theme. So granted, like Friday, you know, it just comes with the news. As I mentioned, if Apple goes down, the markets will follow.
That's what you
so
said.
it's Apple is just becoming your really index. So I would do covered calls in maybe a different instrument, and I'll just be proud owner of either Apple Call or just Apple itself. So
okay, I have that. So I'm just curious what kind of, how could I get extra money? Well, in fact, I'm kind of like knowing that's a probability of being there.
Right. No, but there's still a lot of premium, by the way, for Apple, really out of money too. So you could use some of that. So basically.
Can I also ask another follow-up question regarding your example of Microsoft? You bought a call and you sold a put, right?
Correct. So there's a
I
double.
I missed the time frame that you used for that one.
June 19th. So I bought it by June 4th. So it was the nearest, because I could see, I didn't think it's going to stay in that low volatility too long. So my bias was up, and also I knew I'm going to pay little for the call options. But I didn't collect with the put, but I was happy to own a 167 Microsoft, 67.5.
Yeah, I know. I wish to.
Yeah.
All right. Thank you so much.
Of course. Okay. Any other questions?
Ramin, Ahmad here, sorry.
Ahmad, yes. Hi.
Hi there. Any suggestions on, understanding the futures market a little bit better? Are there any books or any other information you would suggest to get a better understanding of how those markets work?
Okay. Yeah, the problem with futures is it should be the last chapter of your book, in a sense that you want to feel comfortable with the markets. Futures are, it's almost like for me, I'm learning about the card games in casino, and now I want to go play poker, which I don't really have any knowledge in a sense. So I have to kind of learn how the market behaves, because it is pretty much, because it's a leveraged instruments, it can be very difficult. And the books are, all the books that I know, they're very boring. So it's in a sense that if you don't really, as long as you know the markets, you're looking at the FinViz, you're learning all the strategies, that's what the futures are, in a sense. I mean, futures have their own behavior, but it is more about, with the futures, it's all about your money management skills, the risk management. It's more important than understanding how exactly everything works. But if I gave you one great source, would be the CME Group. It's better than any books. Some of these dummy books, or I own. I mean, you're more than welcome to borrow. It's like I got maybe 8 or 9 futures books, but I think CME, you can pick and choose. I'm right, as I said, I finished my book, but it's on the commodities, and obviously use a lot with using futures. So each commodity has its own behavior. So you can use futures to play that, which time of the day and which one, you know, behaves how it does. But as far as trading futures, I will be kind of careful not to get into futures. It's a lot of risks involved, and it's not fun when I had a friend of mine, and he, in 2010, 2011, when the oil market was going crazy, it went over $100, and he thought there's no way it can go to 100. I mean, over 100, 110, 120. So he started shorting the oil. And as you know, oil hit 147. Apparently he had mortgaged his house and never told his wife. And I tell you, this is real story, but also I just want to put it in perspective that, you know, just because of that big margin involved and big leverage, I mean, he was called and he had to come up with a few $100,000 to get out of his position. So the problem is, I'd rather you can learn about it, but I don't want to get involved with it yet, Hamad. So, but you're more than welcome. We can have this discussion again. Once my book is out, that would be great. But we will do some maybe videos on it. But the futures are a very dangerous game to play. Not initially.
Got it. Thanks for the tip. And then I just wanted to make a quick comment that these examples, whenever you're explaining a concept with the example, it is so much more meaningful, at least for someone like me, than actually, half of the other conversation was going at least above my head. But, when you pick an example like Microsoft made perfect sense to understand what the strategy was. Just a quick comment that is
thank you,
very, very helpful.
Oh, thank you so much. Good. Good.
Ramin, I have a quick question.
Oh, yes.
What's your view on inflation with all the government printing this money? Do you see the long end of the curve going up, or what's your view?
Very good question. I mean, I should ask you this, but Jean-Claude, with all your experience. But it is, that's a concern I have, because even in Europe, as you know, they're basically just artificially they're controlling the yield curve. I mean, this is what the central banks are doing. And eventually, it's just gonna come back at us in the face. So right now, I mentioned before, they're just trying to keep the patient alive. But this patient is, it's going to be alive, but I don't know if it's going to be active. So right now, as you know, the inflation is, when we look at the M2 and we look at the volatility of, or velocity of the money, and of course, the biggest thing would be earnings. So we don't have that. So that's a plus for the Fed, knowing that we don't have the earning inflation. The question is, the markets are telling us something different. I mean, when you have gold, which is historically is the only really commodity, which is the storage of the value, the gold is worried. It's not. I've been a holder of gold since the 80s, and 80s and 90s, it was the most difficult time to own gold. And basically that was telling us, we are in an economy with a really managed inflation. But right now, gold is getting closer to the all-time high was this 2011. So if you were in a country like Argentina, I mean, the inflation would have been ultra high. So we are right now, because of the governments, the central banks, they're always worried about deflation more than inflation. So that's why countries like Japan, they're still trying to create that inflation, and they can't. Organically, it's not there, because they've just controlled so much of through the currency and also the yield curve, and having a negative yield. So, but in a normal environment, we should have a very high inflation. But I think when Fed came and said, well, till 2022 at least, they're going to keep this artificially low, then I just have to go with what they have to do. But I think you're going to see, again, from the economic point of, I mean, from the world point of view, I'm positive. I think with our youth and, you know, things, but eventually we have to pay the piper. And I don't know how we're going to do it. Eventually, you know, you got to either devalue your currency one of these days to pay your debt, or, and that will be, you know, obviously inflationary. So, but in the short term, I don't see as a danger, but in the long run, it is a concern. And that's why I watch the dollar and I watch the other currencies. And that's why I think once in a while we talk about Bitcoin and alternative currencies, because it looks like they do have a place in the future. And there is some movement going there to make sure they avoid things like this. So I don't know if that answered your question.
No, it did. Thanks, Ramin.
Okay. Thank you very much. Okay. Excellent. Excellent questions. Any other question? Comments? I love the comments. You know, we're close to almost 4 o'clock, so.
You preempted my question. I was going to ask if crypto is
yeah.
a good hedge.
I think in the long run you will see, and that's why I like to watch. You know, I think again with the youthful movement I've mentioned before. I mentioned before because of the social movement. Also, the government's really getting involved in a lot of things. We are going to have definitely higher taxations. There's going to be some unrest. I think I definitely need some alternatives. And you know, as you know, a lot of manipulation goes on, whether it is planned or not. But I think this is here to, in my opinion, it's here to stay. These digital currencies for the next 10, 20 years, they're going to play a much bigger role. So, yeah.
Ramin, I already used my turn. Can I ask one very quick question?
Of course, we still have time. Yeah.
So, I mean, if you have a good sense using multiple, you know, technical indicators that you've been, you know, explaining to us in last several weeks on the direction of a particular stock, either going up or down, say next some time frame, and the stock itself is, you know, just too expensive, so you can hold somewhat quantity of it, but not a whole lot. What would be the next strategy where you can still control your downside risk, but, you know, play a little bit bigger than just buying the stock outright?
Right. So, yeah, that would be the next. That's what you could use, that's why these option strategies are wonderful. I mean, there's a lot of, but if you understand, first of all, what is buying an option and what is selling an option, once you understand those two concepts, you can marry them together and have a nice controlled strategy that it limits your risk, it limits your profit, but there is, again, everything about investing is about probability. So if you have a higher probability of success, that's what you want to go to. And a lot of people say, well, options are so risky, and, you know, because, and that's the problem I had. My initial thing was, again, little knowledge becomes dangerous, is because people, they buy call option or something, and then they say, options are like worthless. Well, no, if you have a right strategy, it's a wonderful tool. To answer your question, and I think that mentioned, it's like a bull spread, right? So you can do either bull call spread or a put spread. You could have a nice upside potential with a downside risk. And you can do this every week. You can choose maybe a couple of indexes or maybe a couple of stocks that you're very comfortable, you see their behavior, and just learn about this spread strategy, which is not very difficult, and do that rather than, and put a very little capital, very little margin. You don't get called. If you're on an airplane, nobody's going to call you, say, well, we exercised your option. by doing that, it has a predictable stream of revenues, but also it's a great strategy in all the markets. And your goal is just want to make sure the probability is on your side. You don't have to be necessarily even 100% right. It's just a strategy covers for you. So the next step will be understanding these strategies. So you don't have to put a lot of capital. For instance, if it's Boeing buying at a 200, now you want to buy 100 shares, that's $20,000. And if Boeing goes up $10, you made 1,000. You can use other strategies by putting maybe 1,000 or 2,000 and still have the potential to make as much money. So once you learn those, and that's what, again, fundamentally, I want to go step by step. Once you feel comfortable, then those are the things that a lot of professionals use. Not a lot of professionals, they just go by, call on stocks and hoping it's going to go up. A lot of these people, they actually play the strategies and they have steady income every week, every month, and they kind of hedge themselves. And I mentioned again, it's more of your satellite strategies. Your core strategies, maybe investing some of the stocks for long term. This becomes your income or satellite that you can take some risk, but it's calculated risk. So we will discuss that more, and maybe we'll have classes in the future with like a video so I can explain that. But there are ways, Hamad. But bottom line is, yes, you can. So it is available.
Okay. All right. Thank you.
Of course. All right. It's almost time. And if not any more questions, again, I really thank you for being with us. It's wonderful. Something that I look forward to, and hopefully we can continue this journey. We'll be together next week. And then again, go ahead and if join the YouTube channel, and if you'd like to subscribe, or if you'd like watch it again, that will be just a refresher. So it's easy accessible. And if you have anyone, any friends that you like them, if you feel it will be beneficial to use, then please recommend and refer them. So, all right.
Hi, Ramin.
Yes.
I'd like to see whether you want to announce, for example, the subscription fees later in an email, or you want?
Yeah. How about we do the email, and then I get the comments this week. If that's okay with everyone, I will go ahead and send everyone an email, and then I would love to hear your feedback and take it from there. How's that? Is that, unless anyone has comment, I'm always open to hear comments. If not, we can just do an email.
Before we close, just really quick, can you post this YouTube channel link somewhere?
I will send it in the email. Follow.
Okay.
Yeah, but it's the last presentation too. It's on once. I mean, it's right here. I can just click on it. Do you see that, Henry? Actually, I'm sharing it right now. It says it was my last slide. So,
yeah, I know, but I was wondering if you can. I can't. We can't click on that.
Right. So, well, the PDF always comes with it.
Okay.
But all you have to do is just go on YouTube, just search RM Smart Investing, and you will see it. Yeah, that's the best, easiest way. But I just put the channel in there. But yeah, just search for it. So great. Okay. All right.
Thank you.
Thank you so much.
Thank you very much.
Have a wonderful week ahead. It's going to be another exciting week. Thank you so much.
Thank you, Ramin.
You're welcome. You're welcome, Jean.
Thank you. Bye-bye.
Bye, everyone.
Bye-bye, everyone. Bye, Hamad.